Hey guys, welcome back to Chalkboard Tutorials. So, taking over from the previous episode about balance sheet, we'd be going into a little more depth. We're going to be looking at the assets and the different kinds of assets that are available on the balance sheet. Just as a quick recap, I just want to show you guys how the cycle of revenue kind of operates. So, if you remember from our previous video, cash always takes the top line of a balance sheet, the most liquid assets. Now, this cash enables us to buy inventory. So think of your stuff like your raw materials or your partially built products or products that are in the shop and waiting to be shipped out. These inventory, once sold out, which is once shipped out from the factory store or the warehouse, becomes accounts receivable. So it's off the floor, so to speak, and we are expecting for the revenue to come back in. And once accounts receivables comes back in, it goes back up as cash, which then in turn pays for inventory. So it's a nice cycle about how the products that you make or the assets that you make, once sold, turn into different lines in the balance sheet. Now, let's have a quick look at the assets section of the balance sheet. So we have our assets. Now, as mentioned in the previous video, the first section of your asset sheet is always going to be current assets. This is going to be the same for your liabilities. It's going to be initially started off with current liabilities. Now, current assets and current liabilities are cash flows that you can expect to happen within the next 12 months. So current assets would be assets that would provide you with some kind of revenue in the next 12 months. The second portion of the balance sheet asset section is other assets. Now, once you have a company, there will be certain assets that you hold that might not have a quantifiable or a physical space, right? A good example is intellectual properties or any rights you own or any goodwill or intangible assets. These are assets that have value, but it can't be physically accounted for. Again, we would be going into more in-depth videos about intangible assets and goodwill and so to speak, but for the purposes of this video, the second section would almost always be other assets, which, as I mentioned, would be things like intangible assets or patents or rights. Now, the third section in the breakdown of the assets section would be fixed assets. Now, if you're operating a business, you would have assets that are fixed, particularly things like your PPE, so your property, your machines, your equipment, your office spaces, things that are sort of fixed assets, things that either bring you revenue or things that don't have you spending out money, but things that are less liquid than, say, your current assets or your other assets and your intangibles. So a good way to think about fixed assets is things like property, land, equipment, so on and so forth. Now, the fourth section of your assets would be something known as accumulated depreciation. So, accumulated Now, the concept for depreciation is pretty simple. If you own something over a period of time, the value of that asset would erode or it would decline. So this is just taking into account the depreciation, so to speak. So if you own a building, there's going to be a bit of erosion of value depending on wear and tear. You'll have your fixes, you'll have plumbing, or you'll have some kind of reconstruction. Building's probably not the best example. Think of it as like a truck. You own a truck or a car for your business purposes. 5 years of you using that car will have definite amounts of wear and tear, where it will not be in the same value as if it was brand new. So this accumulated depreciation just takes into account the declining value of said asset. Now, quick formula to remember is you'll be looking at net fixed assets, and all that is you take your fixed assets, your property, your land, your equipment, so on and so forth, and you add it with your depreciation, your accumulated depreciation. So I'll just put the formula in here. So you've got your net fixed assets just pick a different color, and you've got your fixed assets. And you add it with your accumulated depreciation. Now, we've kind of gone through all the sections of the assets portion in the balance sheet. Now what we're going to do is we're going to try and find out what the total assets are, and which is pretty simple, very basic. You just add up all these values. So to get total value, all you do is, so total assets, it's equal to, you add the current assets. Let's just pick a different color. And you add your current assets with your other assets, and once again you add on your net fixed assets, which is just basically the sum of your fixed assets and your accumulated depreciation.